Hello and welcome back to the Fixed Income Securities series of NISM. Let's continue with the next chapter, that is chapter 1.7, Evolution of Debt Markets. India has a large bank-dominated financial system with banking sector providing large credit to corporates. The regulators, both RBI and SEBI, have been putting in place many structural changes to improve the debt market access so that the dependence on banks reduces. Corporate bond market global scenario. At over 322% of GDP, global debt at the end of 2019 was 40% points, $87 trillion, higher than at the uh, onset of the 2008 financial crisis. At the end of 2019, in mature markets, total debt topped $180 trillion, over 383% of these countries' combined GDP. While in emerging markets at $72 trillion, it was double the level it was in 2010, driven mainly by a $20 trillion surge in corporate debt. China's debt was nearly 310% of its GDP, one of the highest in emerging markets 2010. Domestic bonds had the highest share in total debt securities, with the share of general government debt at nearly 49% of total debt outstanding. Globally, corporate debt markets are over-the-counter markets. The transactions are concluded among large institutions or dealers using a telephonic link rather than accessing exchange platforms like equity markets. As these markets are wholesale in nature, with very large institutions taking part, retail investors are generally absent and they typically invest through collective investment scheme like mutual funds. Corporate bond market in India. In India, corporate debt transactions are executed bilaterally between the counterparties and reported to the exchanges for settlement purposes. Recent years have seen increased collective investment vehicles such as mutual funds and alternative investment funds, that is AIFs, taking part in debt market investment. Mutual funds have played a very crucial role in channelizing the savings to the debt-oriented schemes. In order to stimulate flow of foreign investment into debt market, regulators have gradually increased the limits for investment by foreign portfolio investors. FPI investment in bonds is also subject to appreciate ceilings, which are normally lower than the aggregate ceiling on government bonds, but represent a higher percentage of outstanding corporate debt securities. The authorities also raised the maturity limits on FPI debt holdings, lowering the minimum maturity to 1 year from the previous 3-year limit. Consistent investment interest by domestic institutions like mutual funds, pension funds, and insurance funds, as well as foreign portfolio investors (FPIs), has helped in developing the corporate bond market. Chapter 1.8, Market Dynamics. The debt market in India has grown significantly over the past 2 decades. However, it is still dominated by the government debt segment. Although the share of the central government has been gradually coming down and that of the states rising, the extent of outstanding corporate bonds as a percentage of a country's GDP is often referred to as penetration. The penetration data is an indicator of the level of development of the bond market in a country. Penetration of bond markets in India, however, remains low in comparison to developed countries. The Indian corporate bond market has grown over the years. The issuances are predominantly through private placement and dominated by high credit issuers. In 2019 to 2020, 71% of the issuances were by entities rated A or higher, of which AAA had a share of nearly 44% of the total primary issuances. The private placement of debt as well as transactions in debt securities generally results in fragmentation, low liquidity, and inefficiency price discovery. For example, 24,010 corporate bonds were outstanding at the end December 2019, with an average outstanding size of only 131 crore, as compared to only 116 outstanding central government rated securities with an average outstanding size of 54,138 crore. This have been a major cause of the illiquidity in the secondary market. Despite regulatory measures to give a boost to the segment as part of its effort to boost corporate bond market liquidity, SEBI has facilitated the reissuance of the corporate bonds to reduce fragmentation. That's it for now. We will cover the next chapter in